All right, well, there's another live look at what's happening with the futures. Bit of a mixed story, but the bigger story, of course, if you're watching all the time, is that North American equities have been on a roll. They've been trading at all-time highs, even in the face of trade uncertainty, and we'll continue to watch the trade headlines this week, which has been dominated so far by a slate of earnings. That story is going to continue. We wanted to bring in Philip Petursson, Chief Investment Strategist at IG Wealth Management, to get a sense on what he is watching. Good to see you.
Good to be here.
You know, when shown those cards of earnings or trade or what central banks are going to do or something else, just valuations, what's top of mind for you right now?
Earnings right now.
Yeah.
Obviously, because of this week, it's a big week on the earnings side. And we want to see companies being resilient through the uncertainty. And that's what we're getting. We've got almost 20% of S&P 500 companies having reported to date. 85% have surprised to the upside. That's a positive sign, where historically it's been about 70-75%.
Anything anecdotal you were tracking before earnings season? Because we've got this looming uncertainty. So I know the market's been at all-time highs, but were investor expectations for earnings sky high?
I wouldn't say they were. Coming in, I think investors were more muted in terms of their expectations because they didn't know exactly the hit on tariffs, how that would impact earnings this quarter, or what the guidance would be for next quarter or the remainder part of the year. And so far, I would say the surprises have been to the upside, and they've been encouraging that the tariffs are not as much of a problem for now as people had thought.
And so how does that impact the sort of the mood of the market? I mean, I think last time we spoke, your message was basically like there's not a lot of value in fighting the tape right now.
Exactly. That's exactly it. The trend is your friend. When you think about it, fundamentals are okay. Valuation is fine. I think we've seen valuation move up in other parts of the world, including the United States. But with the backdrop of inflation settling in somewhere around 2 to 3% in the U.S., but interest rates coming down on the short end, that allows for valuations to be at the levels where they are. So. Exactly. You know, don't fight the tape. Don't work against the trend, and realize that all of this tariff noise is exactly that. It's more noise than anything else. Now,
that doesn't mean that you wouldn't be surprised if there was a bit of a pullback in equities. Is that fair?
That's exactly true.
Okay.
And in fact, we would almost embrace that, or we would embrace that. And we wouldn't be surprised by that. We're coming into September. September historically is the worst month of the year. You have a higher probability of a negative return on the S&P 500 in September than positive. October is the second worst, but those are months that you can take advantage of the volatility if it actually pops up.
All right. I mean, it's still just July, Philip, so let's try to take our Canadian summer before we're even talking about September and October, but duly noted on what tends to happen in those months. And I guess if I'm looking, like right now we're showing this one-year chart on the S&P. It's pretty amazing now looking back at that we were down in the neighborhood of 15% or so, and then sort of we rally right back, and so we're up about 7% on the year. But the TSX, and I think most of our audience knows this, is still outpacing the U.S. market this year. Part of that is because of the huge run-up we saw in gold stocks, helping the materials sub-index. But what have you made of where we are now at this point in the year of Canada versus the U.S. equity-wise?
Right. Well, Canada's still attractive. We're still trading at a healthy discount to the U.S. on a valuation basis. If you look at it, we're more than one standard deviation away from the average difference in valuations between the U.S. and Canada on a PE basis. So that allows for still a catch-up trade to be embraced for the TSX. In addition, when we look ahead, now this is out of consensus, but we see oil prices with risk to the upside. So we think that supply could tighten in over the course of the next year. That could start to drive the price higher. And the energy sector, which historically has been one of the key drivers to the TSX, really hasn't participated that much. But if it does kick in with higher oil prices, well, we can see another leg up for the TSX beyond what we've already seen.
Well, and just to throw some numbers at folks, like energy is lagging the market this year. I mean, the TSX energy subgroup is up about 2%, a little less than that. The TSX is up more than 10%. But that component, energy, is the second most influential in the TSX after financials. So I get your math there. But walk me through your thinking on demand and supply, because it feels like the narrative of late has been that there's too much supply in the oil market.
Yes, and that, I think, is the case today. But what we're seeing is demand is actually increasing. If you dig into some of the numbers, some of the research that we're seeing shows that demand might be a little bit stronger than what the IEA has been putting out. In addition, if you think of where a lot of the excess supply has come from, shale in the United States, those wells have a short lifespan. And so if there isn't constant reinvestment into new wells, then you'll see that 13.5 million barrels a day taper off potentially fairly quickly. And this could be a 2026 story where U.S. supply starts to taper off. The economics aren't in place yet for these energy companies to continue to drill, and that can push the price higher as supply tightens up.
We do start to get a little deeper into tech earnings this week. Of the biggest players, Netflix already reported, but they're really more an entertainment play. You've got Tesla and Alphabet. When we're talking about sector weightings, tech is so dominant in the U.S., less so in Canada. But how are you thinking about the technology sector, its influence, how people are going to react to the earnings story, the role it plays, I suppose, in a market that, as you said earlier, you don't really want to get in the way of the equity market right now?
It's all about AI when we're talking about technology and how companies are investing in AI, how they're going to monetize AI going forward. And that's fairly uncertain. But the companies that are the big ones that are investing heavily in it have the cash. They're not raising debt to do this. So it's not like they're bleeding cash to invest in a technology that is unproven yet. So the tech sector, look, people wrote off NVIDIA as overvalued or dead. And now, look, it's continued to reach new highs. It's, I think, the biggest company in the world by market cap now. Yeah. And so it's something that you can't ignore. I think the question is, where do we go from here, and who are going to, or which companies are going to be the winners in monetizing AI? You have every company that has come out with their own version of it, but who's ultimately going to be the market leader? That's the unknown. So it goes back to, fine, invest in the picks and shovels, which is NVIDIA.
And then just it's not an easy question, but I'm going to ask it quickly, is just because for now, we've got this August 1st deadline on the tariffs, and obviously the Prime Minister is meeting with premiers, and we're all trying to figure out how we're going to navigate through that. Where do you think the market's mind is on the trade stuff at this point?
Based on the direction of the equity indices over the last couple of weeks, it seems that it's a story of the boy who cried wolf one too many times. And it doesn't seem that there's any real risk priced into the market for another tariff tantrum. Or an impediment to earnings coming from the tariffs. So and this is how we're treating it too. Remember, the August 1st deadline, it was a delay from the July 9th deadline, which was a delay from Liberation Day. So I fully expect, and we've heard Scott Bessent last week say, look, the China deadline is flexible. So the August 1st deadline, is it really a deadline, or is it just the next one that's going to be pushed off to a later date? I think that's more likely the case.
Okay.